Some examples. Short term. Vanguard short-term investment grade. There's the ticker symbol. By the way, these are all no-load funds, meaning there's no sales charge or commission to buy or sell. All right, you can buy it 1 week and sell it the next week, and there's no fee. So, you know, you're getting 2.7% right now on this. You own short-term government and corporate securities. Duration 2.0. What is the duration? How does the duration number matter? What it means is that if long-term interest rates were to go up by 1%, you take your duration, and that tells you what your principal would decline by. Okay? So if long-term interest rates go up by 1%, your principal would decline by 2% in that fund with a 2 duration. Likewise, if interest rates drop by 1%, your principal would go up by 2%. So, not a lot of risk in this one, but again, the problem is it's near 52-week highs. So I'm not buying it right now. But you know, if you're stuck in 0% or 0.5, you know, whatever the banks are paying these days, you know, this is helps get you a little more yield without much risk. Next is Templeton Global Bond Fund. And this is the advisor class. So you need, if you're not working with a fee advisor, find one, and that's how you get this fund. Otherwise, I believe Franklin Templeton, you're going to pay a load.
And that'll drop your current yield way down.
This fund here, this Templeton, is managed by a guy named Michael Hassenstad. He's a PhD. He's Morningstar's Fixed Income Manager of the Year. He has put together an unbelievable track record. And it's a global bond fund, so he has the ability to buy treasuries. Guess how much he has in treasuries right now? Zero. Zero. You know, he's big into Australia, Brazil, and Norway. So you're diversified out of the dollar, and it's a great fund. Problem here again, it's been on a tear. It's made a big move. You need to wait for a pullback before you commit any new money. A couple others. This is the mortgage-backed securities fund I mentioned. Double line total return. Jeffrey Gundlach is the manager. He was on the cover of Barron's a few weeks ago, titled "The New Bond King." All right? You stack up his performance here against Bill Gross at PIMCO, this one kills it. So if you're, you know, he's got a great team. He was with TCW, had a falling out, set up Double Line as a new firm last April. This fund has been tearing up the track. And again, there's still opportunities in mortgage backs. Because of the discounts that are still available in these securities, the yields are high. That's how he's generating that 8% with a low duration. So it's high return, low risk. It's like the best of both worlds. So we are heavily invested in that one. But again, with any fund, you know, it's not like a child, you know, or a pet. You know, you don't have to own it for life. Okay? You can sell it. All right. Lastly is a muni fund for people that are looking for tax-exempt income. Again, this is a high-yield muni, so it owns some of those land-based tax-backed bonds that we talked about, run by American Century. The interesting thing about this one is even though it has a fairly long duration of 8.1, the yield is fantastic for a tax-free, and it is not as interest rate sensitive as, say, a Vanguard fund, which is more investment grade. So if you watch this on a day-to-day basis, you'll see that it does not bounce around as much. It's more sensitive to the economics and the credit risks as opposed to the interest rate risk. Okay. Closed-end funds, we don't own any right now, but they trade on the exchange. They trade on the New York Stock Exchange. They're different than open-end funds in that they issue just a fixed number of shares, and then those shares trade on the exchange. So what happens with these is the market price will differ from the NAV. So you have an opportunity from time to time to buy them at a discount. So you can buy dollars for 90 cents. They're fairly thinly traded, so you always want to use a limit order as opposed to a market order. Remember, with a limit order, you specify the price you're going to pay. And these pay monthly dividends. There's an X date. So we like to buy them on the X date because remember, that's when the share price drops by the amount of the dividend. So you buy them right after they go X and get the lower price. And the thing to be careful of is that most of these closed-end funds use leverage, and that's a big red flag to us. We would not buy a leveraged closed-end fund. There are some out there with no leverage, and those are the ones you want to look at. Okay, ETFs. These are the new kid on the block. Peter's talked about them. They're flexible. You can buy them, sell them during the day. They're tax efficient, so they work really well in a taxable account and a tax favored account. Again, use limit orders. You can see the growth in ETFs. The first ones came out in '95. At the end of last year, there were 923 of these out there with almost $1 trillion in assets. So there's been a tremendous growth. One reason why is the low cost. You look at expense ratios here. ETFs are on the top. The expense ratios are on the bottom, starting at 0.1 up to 1.5. You can see the expense ratios down here of actively managed funds and index funds and of ETFs. ETFs are low cost and flexible.
Scott, let's go to the fixed income strategies slide.
Okay. There we go. For your strategy, own individual bonds. What's the maturity date of a bond fund? None. There's no maturity date. That's the big difference between an individual bond and a bond fund. With individual bonds, you have the certainty of maturity date when you know you're going to get your principal back, and you have the certainty of the interest payments. Bond funds can change the interest payments, and the share price will definitely move around on you. Stagger your maturities with individual bonds. You know, there's not a lot of value at the short end right now. The yields are so low. Intermediates is a good place to be. You know, if you want to have some short, that's good. But consider a barbell strategy where you also have something a little longer to get some yield pickup. Own bond funds and ETFs for the diversification, monthly dividends, and better liquidity. And like we talked about, beware the interest rate risk on long-term bonds. This shows what inflation does to your purchasing power over time. Somebody that retires with $100,000 in income, and with 3% inflation, you can see how your purchasing power declines over the years.
Could you go right to the dividend-paying stocks?
Yeah, I'm getting there. All right. So here, this shows the returns of the asset classes over time. This shows the past 20 years, and this shows the past 10 years. Notice that large stocks have only returned 1.4% over the past 10 years. The worst performance of the major asset classes. What does that tell us? That's probably where the opportunities are for the next 10 years. Okay, so consider dividend-paying large company stocks. Normally I give some names. I'm not going to give any names today.
Really?
No. Sorry.
Wow. You're not going to give any tips?
No.
Okay.
I mean, consider some late cycle industries that really haven't been caught up in this frenzy that we've had lately. Consumer staples would be one area to look at. Utilities, another area. Maybe some healthcare names that have been held back because of the the overhang from the Obama legislation.
One. Give us one tip.
I'm not going to give one.
Not even one? Okay.
No, there's
Johnson & Johnson?
There's a great ETF. If you want an ETF, SDY. SDY. That's the spider. That's the Dividends Aristocrat Index. This is an ETF that's comprised of companies that have raised their dividend every year for the last 25 years in a row. Okay?
Building a better portfolio, that'll end it.
Okay. Diversify. Hedge your bets. You have to. You've got to spread your money around. All right? Own what we've talked about. Bonds, funds, and ETFs. If you're sitting with too much money in low-yielding investments, there's a big world out there. And consider muni bonds for tax-exempt income. There's still some good pricing inefficiencies in the muni bond market. And then own dividend-paying blue-chip stocks for good quarterly income that will grow because good companies will increase their dividends year after year. So you have a built-in inflation hedge with that dividend increases and the future capital appreciation. And get active, study it, or hire it out. Some helpful free websites, and lastly,
commercial.
You're eligible for 1 hour portfolio review. Thank you for your time.
Wait a second. We're not going to let you off just so quickly. What is the purpose of the fixed income portfolio in an asset allocation model? Is it just to bring income?
Safety, income, and a hedge against stock market risk. Because, like we said, when everything tanked in 2008, treasuries were strong. That's not an argument to say and go out and buy treasuries today, but you look at the volatility of bonds and of these fixed income securities that we've talked about versus stocks, and they're a lot less volatile.
Yeah.
So it's a safer component of the portfolio.
Yeah. We had a woman in the previous class, and she came up to me afterwards, and she said, "Isn't there anywhere I can get a safe return for over 1%?" And so, and I'm not likely. I said, "Well, what is your net worth?" That's one of the first questions. I mean, how desperately do you need the income? And she said, 40 million. And I said, 40 million, and you're worried about 1% income, or getting 1% on her money safely. I said, why are you so concerned? And she says, it's just not any fun getting so low of return. And we tend to focus in on that yield. But remember, your fixed income portfolio prevents that whole portfolio from going down. It provides that safety nest. And so think of your fixed income portfolio as the steady part of your overall. And it's very difficult today to invest in this area. So, Scott, thank you for a great job. Okay.